Most people think saving big on taxes requires secret tricks or shady offshore accounts. But that is not true. That is a myth, and a dangerous one. The real path to significant tax savings is not in the shadows. It's right in the open, written in the U.S. tax code. The government creates these rules to encourage behaviors like starting businesses, creating jobs, investing in real estate, developing domestic energy. Understand those incentives, and you can align your finances with them. This isn't about loopholes. It's about using the map the government already gave everyone. You've worked hard for your money. You've taken risks. You've built a business. You've invested wisely. The goal isn't to avoid paying your fair share. The problem for many successful small business owners, consultants, freelancers is a tax known as the self-employment tax. If you operate as a sole proprietorship single-member LLC, you pay this tax on every single dollar of your net profit. This is in addition to your regular income tax. It covers your contributions to Social Security, Medicare, and at a rate of 15.3% on a significant portion of your income, it adds up very quickly. As your business grows and your profits climb, this tax can become a substantial and frustrating burden. The solution is an elegant and widely used strategy: electing S corporation tax status. When you make this election, you change how the IRS views your company's profits. Instead of all profit being subject to self-employment tax, you are required to pay yourself a reasonable salary. Only this salary is subject to payroll taxes, the employee share of FICA, the employer share of FICA, which is the same 15.3%. Any remaining profit from the business can be taken as a distribution, which is not subject to self-employment or payroll taxes at all. This single move can create an immediate and significant tax savings. Let's look at a clear math example. Imagine your consulting business generates $400,000 in net profit. As a sole proprietor, you would pay self-employment tax on that entire amount, resulting in a tax bill of roughly $37,000. Now let's say you elect S-Corp status and, after consulting with a CPA, determine that a reasonable salary for your role is $150,000. You would pay payroll taxes only on that $150,000 salary, which comes to about $22,950. The remaining $250,000 is taken as a distribution. The problem with traditional rental real estate is how the IRS classifies the income and, more importantly, the losses. Paper losses are common early on because of deductions like depreciation, but you generally cannot use those passive losses to offset your active job or business income. The passive loss gets suspended and can only offset future passive income. That limits immediate tax savings for high earners. The solution is a special exception for short-term rentals. Short-term rentals. If you meet specific criteria, the IRS may not treat your rental as passive. Test 1. Average tenant stay is 7 days or less. Test 2. You materially participate in the activity. If both are met, net losses are no longer passive. They become active losses you can use to reduce W-2 wages or business income, dollar for dollar. Example: buy a vacation property for $500,000. You actively manage it, handling bookings, communicating with guests, arranging cleaning. Year 1. After income, expenses, and depreciation create a $30,000 paper loss. If long-term, that $30,000 would be stuck. Under STR rules, that $30,000 becomes an active loss, at a combined 40% tax rate that saves $12,000 this year. A common problem for successful business owners is a disconnect between their operating business and the real estate it occupies. You might be paying rent to a third-party landlord, which builds their equity instead of your own. Or you might own the building in a separate entity, but the tax rules still treat the rental income as passive. This creates an inefficient situation: passive rental income in one pocket, active business income in another, and you can't use powerful real estate deductions like accelerated depreciation against your high-tax business income. The structure prevents you from maximizing tax benefits. The solution: the self-rental strategy plus a special tax election. How it works: create a separate LLC to own the commercial property your operating business uses. Then, your CPA files a formal grouping election on your return. The election tells the IRS to treat both entities as one active business for tax purposes. That recharacterizes rental income from passive to active, so deductions flow to your business profits. Example: your business buys a 2-Matlers office building. You place the building in a separate LLC and make the grouping election. You hire an engineering firm to do a cost segregation study. The study identifies building components that can depreciate much faster than 39 years. You might get $600K of value written off in year 1 via bonus depreciation. Section 5. Oil and gas. Working interests. An uncommon but potent deduction. One of the biggest hurdles in tax planning is the passive activity loss limitation. As we have discussed, most investment losses, like those from rental properties or limited partnerships. This means that you can't use them to offset the income you work hard for, such as your salary or business profits. Investors are constantly searching for ways to generate deductions that are not restricted by these rules, allowing them to lower their overall taxable income in the years they make the investments. This is especially true for high-income earners who face the highest marginal tax rates and have the most to gain from immediate large deductions. The solution, though not for everyone, can be found in a specific type of investment, an oil and gas working interest. Unlike a royalty interest, where you just receive a check, a working interest makes you a part owner in the drilling operation, responsible for your share of the costs. Because of this direct involvement and risk, the tax code provides a huge exception. A working interest is generally not treated as a passive activity. This means that the deductions generated from the investment can be used to offset any type of income. The most significant of these deductions is for intangible drilling costs, which can be 70 to 90% of your initial investment and are 100% deductible in the first year. Let's run the numbers. Suppose you are an accredited investor and decide to invest $100,000 into a qualified oil and gas working interest partnership. The operator tells you that approximately 80% of your investment will go toward intangible drilling costs. Because of the special non-passive rule, you can deduct that entire $80,000 portion in the year you invest. If you are in the top 37% federal tax bracket, that $80,000 deduction translates directly into a tax savings of $29,600. So, 80,000 times 37%. You have effectively reduced the at-risk cost of your $100,000 investment to just over $70,000 thanks to the immediate tax benefit. Be very aware of the warning. These investments carry significant risk and are not suitable for all investors. The drilling operation could fail to find oil, and you could lose your entire investment. Furthermore, you must invest directly as a working interest owner or through a partnership that does not limit your liability to be eligible for this favorable tax treatment. Many oil and gas deals are structured as limited partnerships, which would make the losses passive again. You must perform thorough due diligence on the operator, the geology, and the specific legal structure of the deal. Always consult with a financial advisor and a tax specialist before venturing into this complex area. Section 6. The Safe Harbor Rule. Eliminating underpayment penalties. Guessing game. Safe Harbor. 110% of last year's tax. A frustrating problem for many business owners and high earners is the threat of underpayment penalties. The U.S. has a pay-as-you-go tax system. That means you must pay taxes throughout the year, via withholding or quarterly estimated payments. If you wait until you file your return in April to pay the bulk of what you owe, the IRS will hit you with penalties and interest for underpaying during the year. For people with fluctuating or rapidly growing income, accurately predicting how much to pay each quarter can be a stressful guessing game, and getting it wrong is costly. The solution is to use the safe harbor rules for estimated tax payments. This is a simple, formulaic approach that protects you from underpayment penalties, regardless of how much your income increases during the year. The general rule is to pay in 4 equal quarterly installments, 100% of the total tax you owed for the previous tax year. For higher income taxpayers, those with an adjusted gross income over $150,000, the bar is slightly higher. You must pay 110% of your prior year's tax liability to qualify for the safe harbor. Here is a simple example. Let's say in 2024, your total tax liability was $200,000 and your AGI was well over $150,000. To avoid any underpayment penalties for the 2025 tax year, you simply need to pay 110% of that prior year tax. The calculation is $200,000 times 1.10 equals $220,000. You would then divide this total by 4 and make 4 equal quarterly estimated tax payments of $55,000 each. Even if your income doubles in 2025 and your final tax bill ends up being $400,000, the IRS cannot charge you an underpayment penalty because you met the safe harbor threshold based on the prior year's liability. The crucial warning: remember that meeting the safe harbor only protects you from penalties. It does not reduce the total amount of tax you ultimately owe. In our example, even though you paid $220,000 during the year and avoided penalties, you would still have a large balance due of $180,000 when you file your tax return in April 2026. While this strategy is excellent for penalty avoidance and simplifying cash flow planning, you must be disciplined. You need to set aside the additional cash you will owe so that you are not caught by surprise with a massive tax bill at filing time. Section 7. Putting it all together. A framework for action. Knowing these strategies is one thing, but implementing them correctly creates real savings. Move from passive learning to active planning. Don't try to apply every strategy at once. Develop a clear, methodical framework. Evaluate which moves suit your specific financial situation. Start by getting a firm grasp on your numbers. Income sources, current business structure, investment portfolio, projected tax liability under your current setup. This is your baseline, the before picture. Once you have your baseline, model the impact of each strategy. Keep it simple. Spreadsheets work. Create a column for your current situation. Add columns for each strategy you're considering. Sole proprietor tax liability S Corp with a reasonable salary cost segregation tax savings on a property. The before and after comparison makes the impact crystal clear. A few guiding principles will keep you on track. First, don't let the tax tail wag the dog. Don't buy a rental you don't want just for taxes. Second, prioritize meticulous record keeping. For short-term rental exceptions, prove material participation with a time log. Non-negotiable. For S-Corp, document how you set a reasonable salary. Good records are your best defense in an audit. Finally, tax planning is ongoing, not one and done. Income changes, tax laws change, goals change. Build an ongoing relationship with a top-tier CPA or tax advisor. They are your strategic partner. They alert you to new planning opportunities. They ensure elections are filed on time. They help navigate tax code complexities. A good advisor helps shape your financial future and avoid costly mistakes. Your next step. From knowledge to tangible savings. We have debunked the myth that tax savings require secret offshore accounts. The truth is far more empowering. Substantial legal tax reduction comes from understanding and applying Congress's rules. These rules are incentives to reward work investment risk-taking. We have walked through 5 powerful examples: S-Corp election real estate deductions, energy deductions, safe harbor rule. Each one offers a clear path to keeping more of your hard-earned money. The common thread is proactive planning. Tax savings aren't found by accident in April. They are created by deliberate decisions made in January, June, October. It's about structuring your business correctly, choosing your investments wisely, documenting your activities meticulously. Treat tax planning as part of your financial strategy, and you turn a yearly chore into a powerful wealth-building tool. Stop being a passive rule follower, become an active participant in shaping your financial destiny while operating fully within the law. These ideas are not mutually exclusive. A successful owner might elect an S-Corp to save on self-employment tax, use a self-rental strategy for their commercial building, apply the safe harbor rule to manage quarterly payments. 2 or 3 of these moves can easily save over $50,000 a year. The potential is real and legally available. Knowledge is the first step, but it's useless without action. Your journey from overpaying taxes to optimizing them begins now. Schedule a consultation with a licensed, proactive CPA who specializes in tax strategy for high-income earners. Do not just ask them to do your taxes. Go to them with this list. Ask them to run the numbers for your specific situation. Ask, what would be the impact if I elected S-Corp status? Ask, can you model first-year savings of a cost segregation study on this property? This is how you start a conversation that can save tens of thousands of dollars. Good planning is an investment with one of the highest possible returns.